But my name is Juliet Greco with the Catholic Foundation of North Georgia, and I'm so pleased to welcome you all to the Legacy event, the New Tax Law and Charitable Giving. So just continue to eat and enjoy during the presentation. I wanted to mention anyone that wishes to have the continuing education, the CLE or the CFP credits, please make sure to let us know at the check-in table. And we also want to thank Atlanta Catholic Radio, The Quest, our media sponsor, for helping us to promote this event. The Catholic Foundation helps Catholics with faith-inspired giving, legacy planning, and stewarding the funds for the long-term sustainability of Catholic organizations in our community. So today, hopefully you'll learn a little bit more about those three aspects: the legacy planning, the faith giving, and how we steward the funds for the long-term sustainability of all these important Catholic organizations in our community. So we'd like to welcome our dear friend, Father John Kieran, who is going to start us all with a blessing. Thank you, Father John.
Well, good morning, everybody. Let us take a moment to bow our heads before the Lord, ask His blessings and His grace in what we're doing here today. Almighty God, we beg your gracious inspiration and sure wisdom on our gathering here. We, your children, need your grace help as we deliberate and make plans on the proper use of the resources entrusted to us. We freely acknowledge that the earth and its fullness are yours, and every speck of it is known to you. In this year of hope, we pray that all creation be revered and used appropriately and justly for the well-being of all peoples. Help us today to discern for self and for the diocese how to better respond to the call of our leaders to live by gospel teachings, especially that we respond enthusiastically to Pope Leo's recent teaching that all members accept and live in accord with the option for the poor mandate. Loving Father, we give you thanks for the incredible growth in our diocese and the goodness of those whose sacrifice have made it possible to build and provide multiple humanitarian services over the years. Lead us and bless us by your Holy Spirit, so that by way of cooperation and sacrifice, we do our part to grow your kingdom for the greater honor and glory. We ask through Christ our Lord. Amen.
And now I'd like to call up our board member, Matthew Gries, and tax attorney at UPS, and a deacon in training.
Good morning, everybody. Glad to see you all out here. They just asked me to tell you a little bit about my experience with the foundation and what the foundation is all about. I got involved with the foundation some 17 years ago as outside counsel for the foundation, and I did that until the end of 2016, at which time I went in-house to UPS, and Nancy decided, hey, this is a great time to get Matthew to be on the board since I'm not counsel for the foundation anymore. And now that is Nick's job, who is going to be speaking to us this morning. If any of you are unfamiliar with what the foundation does, it has endowments, it has donor advised funds, and it helps Catholics who want to give back to the community to do that in a great way. And they do such a great job of managing the assets that they have under management. When I got involved with the foundation, the organization just had, I think it was in the single digits millions, and now it has over $150 million under management. I am on my last term on the board, so I'll be rotating off next summer. But it has been a super privilege to be involved with the organization this long. In addition to being on the board, I also started an endowment at the foundation. It is one of the things that I did is I decided to think about what organizations in the Archdiocese mean the most to me and my family. One of them was this foundation because I've been involved with it so long. And the other one was the Catholic Center at the University of Georgia. It is the Catholic Center at the University of Georgia, I credit with my daughter and my son-in-law's very strong faith. That is where they met, they worked together there, they are now married, and they recently blessed me with my first grandchild. And that organization does such a great job at the university that I wanted to give back to it. So I set up an endowment that its annual distributions go half to this foundation and half to the University of Georgia Catholic Foundation. And it's a very easy thing to do. If that's something that you'd be interested in, I'm sure that they could talk to you about it, as well as using donor advised funds, which I think Nick will probably touch on in his speech today. If he doesn't, it's malpractice. So it's in there, he guarantees me. So with that, I will pass it on to whomever is supposed to speak after me. Oh, or I could tell jokes. I have a joke. I'm gonna tell a joke first. Okay. So I've been doing this pastoral care program at St. Joseph's Mercy, going in to visit with patients. And one of the patients told me this joke. He was laying in bed after having a heart attack or whatever, but still had a great sense of humor. And the question was, why do ships in Norway, why do they require them to have a barcode on the side? And the answer was, when they come into port, they can Scandinavian. So anyway, all right, with that, I'll pass it on.
Thank you so much, Matthew. And we wanted to have one of our Catholic partners, grantees, organization that we care deeply about the mission and the important work that they do in our Archdiocese, Pregnancy Aid Clinic. I don't know who was there on Sunday for their tremendous gala. It was just a wonderful, wonderful event of over 700 of your favorite Catholic friends, all in one room. So congratulations on a very successful and wonderful evening. And so we thought that Sarah Weikert, and we've got Carolina Gomez there as well from the organization, would just share a few words. Thank you.
Thanks so much, Juliet. Well, thank you so much for inviting us here. And I'll just give you a few minutes of what Pregnancy Aid Clinic is all about. I'm Sarah Weikert, the Executive Director, and we are very proud to be the largest Catholic pregnancy medical center in the state of Georgia. And for over 41 years, we've walked alongside women and families facing unexpected pregnancies. We offer them free medical care, pregnancy testing, ultrasounds, STI testing, emotional and educational support. So our work is very life-affirming. It focuses on saving lives, changing hearts, and really transforming families. We have 3 clinics in the metro area. We have one in Roswell, downtown Atlanta, and Forest Park. And to give you a sense of our reach, this year alone, we've provided 5,000 patient visits, performed over 1,110 ultrasounds, and witnessed 384 changed hearts, which is a woman coming in very determined about abortion and changing her mind. And I'll give you an example of how a lot of this happens is a couple drove from Tennessee to Atlanta for an abortion. and they were confused, and they accidentally drove to our Forest Park location, which is just 2 doors down from abortion clinic. And we offered them a free ultrasound. And when they saw not 1, but 2 heartbeats, the father broke down in tears. They changed their mind and they chose life that day. So in addition to medical services, we also have an education program that provides classes and nurtures the whole person for these women and men, body, mind, and spirit. Many of the pregnant women that come to us are living paycheck to paycheck. A lot of them don't have maternity leave. So we have a program called our Year of Hope that helps these women that are facing financial crisis. And it's been very helpful to over 25 families this year so far. And while we cherish our mothers and babies, we also know that fathers are important, and we have a fatherhood program. And that provides these fathers with mentorship, one-on-one counseling, practical resources to really help the men grow into the fathers God calls them to be. And then many of you know and have heard about our PATH program. And that is those that have experienced abortion in their lives, those that have wounds from abortion. And so we have a beautiful healing, spiritual healing program that offers compassionate, faith-based care and retreats to women and men who carry the pain of past abortion. So really at the heart of it all is PAC's unwavering commitment to the sanctity of life. And this belief shapes how we care, how we serve, how we walk with women and families through some of their most vulnerable moments. It's about saving lives while also honoring them, nurturing them, and standing beside each one of them with dignity and compassion. And we also brought some information on the table there if you'd like to learn more about our programs and services. And we also would welcome to have you come and experience. We'd show you give you a tour of one of the medical clinics. So thank you so much.
Good morning or afternoon, whichever it is. My name is John Rhett, and I am on the board of the foundation, and I'm very happy to be here today to introduce our keynote speaker. Our keynote speaker is Mr. Djuric, and he has a wonderful resume. I'll tell you a little bit about him. He is a principal at the Fiduciary Counsel of Bessemer Trust. In his role, he is responsible for working with clients and advisors to develop practical and efficient wealth transfer plans and guiding the firm on its fiduciary issues. Prior to that, he has quite an impressive resume. He was a shareholder and the chairman of Djuric Spratt, which was a law firm, and he was associate and partner in Eversheds Sutherland. And previously, he was a law clerk with Chief Justice Gerald Joflat of the U.S. Court of Appeals, the 11th Circuit. He is a fellow of the American College of Trust and Estate Counsel, where he is the Georgia State Chair and serves as a member of the State Laws Committee. He has served as the chair of the State Bar of Georgia Fiduciary Law Section and is currently the chair of the Code Revision Committee. He has previously served as the chair of the Estate Planning and Probate Section of the Atlanta Bar Association and as president of the Atlanta Estate Planning Council. He earned his JD cum laude from Harvard University, pretty impressive there, and an AB Magnum cum laude in Public Policy Studies and History from Duke University. So please join me in welcoming Nick, and we look forward to hearing from you.
It's working. All right, good afternoon. I do not have a good dad joke like Matthew did to share with you. Thank you, though, Matthew, for speaking earlier, and very proud of him, both for his career and for what he's now doing, training. He and I started within a week of each other as tax lawyers. Next year it'll be 30 years at what was then Sutherland, Asbill and Brennan, and now Evershed Sutherland. So it has been a joy to have my career intersect with his career in various ways over the years, including with work for the Catholic Foundation, which I am a great fan as well, and a donor with a donor advised fund as well that will convert to an endowment fund when my wife and I are no longer around. So we will talk about donor advised funds because they are a key part of planning. But my task today is to tell you about the new tax law's effects on charitable giving, because some of the rules for the charitable deduction have changed, and they might affect what you do both this year and into the future. And for those of you who work with organizations and have donors for whom the charitable deduction is a very important part of their giving, this will be important for you to hear, because this will influence their planning and their thoughts about their giving as well. First, briefly, I just like to review, especially for those of you who do work for organizations that rely on charitable giving, just a sort of a brief update on the philanthropic landscape. Giving has steadily risen in this country, helped in no small part by there being a charitable deduction for income taxes over the years. The blue line there is inflation adjusted amounts. So all the amounts there are adjusted to 2024 dollars. And you can see the steady increase. In recent years, we had a surge that was probably pandemic related, and then a fall off after that, which was to be expected. But over the last year, there was a slight increase. And so hopefully we're back on a course of steady increases in giving. Part of that has seen a steady rise in the use of donor advised funds. And we'll talk a little more about how those can work with some of the income tax deduction planning that that has changed under the new law. But a donor advised fund is essentially a charitable investment account that is sponsored by a public charity. The community foundations, and every community has one, has been the traditional sponsor of these donor advised funds, but the large financial investment institutions, the Fidelity and Schwab, really all of them, also sponsor through a charitable arm donor advised funds as well. And then you have organizations like the Catholic Foundation that sponsor them also, even if their primary mission is to hold endowment funds. Many now sponsor donor advised funds, and the Catholic Foundation of North Georgia is no exception. And the way they work is that donations to a donor advised fund are treated like any other charitable donation to a public charity, but the assets are held in a fund that give the donor advisory rights, the ability to tell the charitable institution sponsoring the fund where they want donations to be made out of that fund. It's only advisory, but by and large, assuming that the recommendation is for a legitimate charity under the tax rules and under the rules of the charitable institution as to whom they'll give to, the charitable institution will follow that advice and make that grant to the charity. And there are a lot of benefits associated with it, but the key is that your donation to that fund is when made current, entitled to a charitable deduction like any other contribution to a public charity, but the dollars don't have to go to their ultimate charitable recipient right away. So we'll get back to how we then use these. But now the changes that the law made. So in July 4th, we got a new tax law through the budget reconciliation process. The law got a nickname when it went through the process, the One Big Beautiful Bill Act. It's not its official name, but it is the name that it had through the process. I've heard the administration doesn't like the name anymore and would like a new name for it, but nothing has stuck other than the one that it had during the process. So people call it the OBBBA or OB3 or whatever. I try not to refer to it by that as much as I can. It's just the Budget Reconciliation Act that got passed over the summer. First big change, there's now a floor for those of you that itemize deductions. The first 0.5% of your adjusted gross income is now not deductible for charitable purposes. So your charitable contributions have to be in excess of that amount, and only the amount in excess of that are entitled to a deduction. So the example there is of $1 million of adjusted gross income. That would mean 0.5% or $5,000 of donations would not be deductible. So this is a rule that is, I mean, it's all of these are really just to increase taxes on taxpayers with more significant income done in various ways. And so for this one, it takes away some of the tax benefit of charitable deductions for itemizers. The other one, this applies to all itemized deductions, but that includes charitable deductions. And that is for those taxpayers who are in the top tax bracket of 37%. The itemized deductions, the benefit of that itemized deduction is now limited to the effect it would have if you were only in the 35% tax bracket. Again, this is just another way of sort of increasing income tax on high income taxpayers, but done in a somewhat complicated way by essentially reducing the value of your itemized deductions if you're in that top bracket. What it amounts to is a roughly 2/37 or about 5% reduction in that in the benefit. So for example, in the one shown here, you have $1,000 gift. If that saves you $370 in taxes because you're in the top tax bracket, and to this year, if you deducted 1,000, that would save you $370 in taxes. It's only going to save you $350 in taxes come next year if you're also in that top tax bracket. Okay, so between that 0.5% AGI limitation and this new limitation on itemized deductions, it means that for every dollar you give, you're going to get less of a tax benefit for having given it. There is, though, a benefit for non-itemizers that was put into the code. There had been briefly a benefit during COVID as well, but now it's come back in a larger form. It's not huge, but it is $1,000 or $2,000 for married couples of an above-the-line deduction for charitable contributions. So even if you do not itemize your deductions, you take the standard deduction. If you do make up to $1,000 or $2,000 for a married couple of charitable contributions, you can now still deduct those. And above the line, meaning it comes before you otherwise compute your deductions from your income. So that is a bit of a charitable benefit for non-itemizers that they would not otherwise get because they don't itemize their deductions. They don't separately deduct their charitable contributions. So an incentive for moderate givers, moderate income givers to also give. The limitation, though, on the deduction for the high income taxpayers leads to one recommendation that you're seeing made, which is perhaps consider for this year, 2025, before these changes kick in 2026, you might want to front load your charitable deductions. And what you see on the chart here, and it gives an example of an annual, just the example that I pulled from the Bessemer material assumes an income of $3.34 million, which tells you something about Bessemer clients. And if you were to give $1 million gift and you were going to spread it out over several year period, 5 in this example, which is not an unusual thing to do, especially for something like a pledge, $1 million pledge to a capital campaign or something. And it's permitted for you to get credit for $1 million gift and spread it out over 5 years. The result of that, though, once the 2026 limitations on the deduction kick in, is that instead of, if you were at that highest tax bracket, getting to deduct getting 370,000 of benefit for your $1 million charitable gift, you will only have gotten 330,000, a little over that, benefit from your charitable gift, because in each of those years, beginning in 2026, you got hit with the floor, that 0.5% floor of income, and you got hit with the only getting a 35% bracket benefit, even though your income was at 37%. So what does that mean? It means that if you can do it, make the entire $1 million gift this year, get the full benefit of a deduction under the current 2025 rules. And if you make that gift to a donor advised fund, again, you're treated as having made it all in this year, treated as having made a contribution to a public charity that gives you a full charitable deduction. But you don't actually have to recommend that the amount go out to the charity until you want it to. So you could stick with your plan of having it go to them over a 5-year period without it having to go to them all in the year in which you made the $1 million gift. And it doesn't have to be $1 million to a single charity. Just if your giving is at a certain level, that you would give roughly that amount over that 5-year period. By front loading it all, you're going to be getting a bigger tax benefit for the gift. That has always been, though, a strategy for those that would like to get a benefit, even if they are not $1 million over 5-year givers, but are givers of a smaller amount with even a smaller income. It's always been a strategy, and it continues to be a strategy for taking advantage of using the standard deduction for some years, even if you're not giving enough, because you're not giving enough to itemize. So for example, next year, the standard deduction for a married couple is going to go up to $32,200. It could be that your deductions exceed that through a combination of mortgage interest, your state and local tax, and then your charitable deduction on top of that. And if it does, then you're better off itemizing your deductions. But if your mortgage interest, state and local tax, and your charitable contributions don't exceed that, then you're better off taking the standard deduction of $32,200. And you're essentially getting no tax benefit from your charitable contributions. But if you instead bunched your charitable contributions all into 1 year so that you exceeded the standard deduction amount, then you could take the benefit of that charitable deduction, get that benefit in that year, and then take the standard deduction in each of the succeeding years, just like you would have anyway, without making any of those charitable contributions in those subsequent years. You still get the $32,200 standard deduction because that's what you would otherwise get. So you have, by bunching or front loading all of your contributions into that single year, you're going to get a tax benefit, even though you're ultimately going to have donated the same amount. And again, if you use a donor advised fund, you can put all of that bunched contribution into that fund, but still contribute it on the schedule you might otherwise have contributed it. The amount you give to your church every year, the amount you give to a university every year, etc. So how many years do you bunch? You kind of bunch as many as you can swing, which is You do it all, as to the extent you can, because you're going to get the best tax benefit for it, as long as it's going to be fully deductible for your income for that year. So we see a lot of clients will do that. They'll do 5 years worth, and they'll sort of repeat that pattern every 5 years using their donor advised fund. It really works if you have a year with a lot of income and you would like to get a big charitable deduction for that year. Maybe you've even been thrown into a higher bracket because of that year of income, or maybe it's the last year in which you'll be working, and in your retirement years, the amount you give is not going to exceed, you're not going to get as much of a benefit for it in those final years. Say you're doing a Roth IRA conversion, which is a way of taking a traditional IRA, converting it to a Roth. You end up having to pay all the tax, if you convert the whole thing, on it in that single year. That's a great year to combine with maybe a bunching of your charitable contributions all into a donor advised fund for that year. So that's something that is a good thing to mention to donors who might not have otherwise have thought about that, and whose other deductions might not put them into an itemizing situation. We're going to see lots more non-itemizers because of this increase in the standard deduction. The now 32,200, that's the 2026 adjusted, actually is increased for this year, 2025. And then next year it gets inflation adjusted to the 32,200. And then it'll continue to be inflation adjusted past that. So we're going to see more non-itemizers who can take advantage of these. All right, I've already talked about this. This is how you use your donor advised fund with your bunching strategy. All right, I've talked about just contributions in dollar terms, but what has always been and remains a good strategy is to not just give with cash, but to give with appreciated assets. For example, stocks that have significantly appreciated, stocks that if you were to have sold them, you would end up paying a capital gains tax on it. If you give a charitable contribution using appreciated stock, say $100,000 of Coke stock that you only paid $5,000 for years ago, you get credit for a $100,000 charitable deduction for the contribution of that, but you do not recognize that gain and pay tax on it. The charity gets your $100,000 Coke stock. The charity sells it right away for that $100,000. They get $100,000 of benefit, and because it's a charitable organization, they don't pay capital gains tax on that appreciation. Nobody pays the tax. That's a great thing to do. And so many of our clients will only make gifts with their appreciated stock. And they might just turn around and buy that or similar stock after they've made that. And essentially what they've done is kind of reset the cost basis on their investment there without having to pay any capital gains tax on it. It's one of the few freebies that's still kind of left in the tax code. That means it's also tempting for those who own businesses that they know they're going to sell to want to try to avoid the gain on the sale of that business by giving some of that stock to a charity so that as I said, no one pays any on the gain on that. And that works, but that you have to be careful with. If you are doing it in a way too close to an impending sale, or you're giving it where the sale is pretty much a done deal or close to a done deal, then what the IRS could deem you as having done is really just assigned that income to the charity because it's as good as done. And you'll get treated as if you had sold it in your own hands, subject to the tax on it, and then made the charitable contribution to the charity, which is what you don't want. So the advice is always, please do it as far in advance as possible. And we're always asked how close is too close. And it's almost like if it's close enough for you to ask that question, it's probably too close. But if it's part of your planning from just the start of when you're thinking of selling those business interests, then you can usually give it away. And if you want to give it to something like the Catholic Foundation, they're going to want some assurance that that's that it is going to sell because they're not in the business of holding stock in a closely held company and that. So it's a tough issue. It's a timing issue. You want to have it far enough advanced that you're not going to be deemed to be assigning income, but not too close that you make the charity worry that they're going to be stuck with stock that isn't selling anytime soon. Okay, so plan ahead and consult with your tax advisors. Another technique that has been around and has not changed under the new tax law is to make charitable contributions using what are called qualified charitable distributions from IRAs. And this allows you to direct that a certain dollar amount from your IRA be made directly to a charity. This works only if you're over 70 and a half, and it's still 70 and a half, even though the age for when you have to start taking distributions from IRA has increased over the last several years. For this rule, it's still 70 and a half. What it means is that that deduction goes straight to the charity. It doesn't get included in your income as if it were a distribution to you from your IRA, but it does count for the required distributions. If you are at the age you have to start making those required distributions, it does count as the required distribution from your IRA. So it helps not increase your income, but still getting an amount out to charity. You can't take a charitable deduction for it because you didn't actually make the contribution, the IRA did. And you also can't make these contributions to a donor advised fund or a private foundation. It all has to go straight to a public charity. I think the reason for that is they were worried that the big investment companies, Schwab, Fidelity, that would just get into the business of moving from IRAs right into the charitable fund, everybody's required minimum distributions. And what they wanted to encourage was getting money and dollars actually out to charity. So I think they think the potential for sort of hoarding those amounts were too great. And so they didn't allow those to be used for donor advised funds. There's a strong lobbying arm for getting these to be able to be made to donor advised funds, but it hasn't happened yet. This is also not a change in the law, but a reminder, and a reminder because we've seen cases continue to come out in which the IRS is strictly enforcing the substantiation requirements for charitable contribution. And that is the rule that if you give more than $250 to a charity, you need to receive back from that charity a written acknowledgement of it, and that it states what you gave and it states what you got in return. And if you got nothing in return for it, it should state that you got no goods or services in return for your contribution. Most of you should be familiar with this if you have given an over 250 contribution charity, because you should be getting letters back that acknowledge your gift and state that no goods or services were given in return for this. And if you've ever made a contribution to the Catholic Foundation, you'll get a letter back that has that in it. You need to have those letters by the time the return is filed. And that's where the IRS is being very, very strict about this. So if on audit, they ask for those acknowledgement letters and they're doing that and you can't produce it, you can't produce it then at that time. It's too late and they will disallow those charitable contributions. We've seen several cases in which they stress that they're serious about this and the courts are upholding them. So always save those donation letters because they are an important thing to be able to show that you got it before you filed your return. Just a few other things mentioning about the new tax law. Corporations have always been able to make charitable contributions, but they've been limited to only up to 10% of their income. They will now have not only that ceiling, but also a floor where they won't be able to deduct amounts until they exceed 1% of their taxable income. And actually, for a lot of corporations, the average amount that they do give in charity is actually less than 1%. So this will probably, frankly, eliminate for a large number of corporations, especially smaller corporations, their ability to deduct, which will probably serve as a disincentive for them to make those contributions. So smaller corporations may need to sort of adjust how they handle that. It may involve getting more out to the owners so the owners can contribute and get a personal deduction for it rather than doing it directly for the corporation. It won't affect corporations that do large amounts of their income into charity, but an interesting addition to the tax law. And then come in 2027, this is just something to look out for. There is, many of you, excuse me, will be familiar with Georgia's qualified, forget the exact term, but the tuition, the deduction or the tax credit that you can get for contributions to these student scholarship organizations. Goal is the one that most people are familiar with. There used to be Grace Scholars that was sponsored by the Archdiocese of Atlanta and the Diocese of Savannah that has now ended, and Goal is now where contributions for the support of diocesan schools is also made. But it allows you to contribute a certain amount to that organization and be able to get a state income tax credit for it. Well, this creates a federal sponsored version of it. It would produce a federal tax credit, which is a dollar for dollar reduction in tax is much more beneficial than a deduction, which depends on what tax rate you're in as to how much benefit you get on your taxes. It would create a $1,700 per year credit for individuals. There's a lot of uncertainty about how this is going to exactly work. There are going to have to be these approved scholarship granting organizations. You're not going to be able to get the federal credit if you're getting a state credit for it. So it's unclear how they're all going to work together. So just stay tuned about that. It's not entirely clear how this is going to operate, but we'll probably hear more about it during 2026 as they gear up for doing it. Okay, that is my run through of the new tax law and the changes that are made. And I was encouraged to leave time for questions if anyone wanted to ask them. And I'm happy to try to do that. Yes. Yes. So if you get, the question was, if you do the state program, will you also not be able to get the federal program? What it appears to be is that if you are going to get some kind of state credit for your contribution to this organization that would entitle you to the federal credit, you can't get both. It's not clear though to me yet whether you'd be able to get a state credit for a contribution there and a federal credit for a contribution possibly to a different organization, but it's probably going to require two contribution amounts. In other words, you're not going to be able to get a federal and state for the same contribution amount, we think. Again, still some uncertainty. Other questions? Yes.
You talked about bunching contributions if you're planning to give a pledge of assets to capital campaign or something. Is there a benefit to the charity to get that money over time, like in a capital campaign where it's pledged, it's received over a number of years, or why not just give it to them in a lump sum in that case instead?
Right. The question is whether there's any kind of benefit in the bunching strategy for a charity to whom you've made a multi-year pledge to get it over time, and instead of just making the contribution directly to the charity. I'm sure most charities would say, give it to us all at once up front. It's often donors that would like to seek a spacing out of it, and not always just for cash flow purposes, but also for sometimes they are waiting till the end to incentivize the completion of the campaign, and so they've agreed to defer some of what they're doing because they want to be able to come in at the end and encourage donors. Or it's a kind of campaign where you're kind of worried about the course of the campaign and whether you would actually end up fulfilling the pledge, because sometimes those things don't turn out. Now, that's not the case usually for a large and sophisticated capital campaign, but there could be reasons why the donor wants to space it out. But if the donor can do it all in 1 year, then the bunching strategy works just as well with the straight up gift of a multi-year pledge, in a single sum, as it does to a donor advised fund, and then spacing it out that way. The bunching works best when you've got probably when it's not a multi-year kind of pledge, but your multi-year sort of typical giving, your annual fund type support giving. But that's a good question. Yeah.
Can you clarify the difference between giving stock versus cash to your donor advised fund, how it's treated from a tax perspective?
So the question is the difference between giving cash versus stock to a donor advised funds for tax purposes. So you can give both. You can give really any kind of property that the donor advised sponsor is willing to take. And different donor advised fund sponsors have different gift policies as to what kind of property they will accept. Many of the community foundations and the Catholic foundations do have very generous gift policies. They'll take a lot of things, and it can help a donor who wants to dispose of property that they don't want the responsibility for having to sell to give to the charity. For gift purposes, again, the value of the property will determine the amount of your contribution for deduction purposes and for what you're going to be credited as having contributed to the charity in your account. And the built-in appreciation that you don't have with cash, but that you might have with property, that's the gain that you don't have to recognize then, either you or the charity, if that property is then sold to turn into cash to hold in your donor advised fund and eventually be probably invested into the organization's regular investment program. So the deduction ought to be the same. The tax benefit of giving property instead of cash is that you have the possibility of avoiding tax on gain on appreciated property. It doesn't work with loss property. You can't get a loss for contributing property that you have a loss in to a charity, but it does work with property with which you have a gain. Yes. I hope that answered the question. Go ahead.
QCDs. You mentioned that QCD
an endowment fund it can go to. Yes. Congress. As I said, I think they're worried that about a greater likelihood, because so many donor advised fund are sponsored by the same financial institutions that also hold a lot of IRAs. I think my guess is that they were worried that the investment company, they're obviously interested in collecting a fee off of the investments. So if they can shift from your IRA to a donor advised fund, they still collect the investment fee off of it, but they won't if you give it away. And so I think there was a worry that they'd be strongly incentivized to encourage a lot of contributions to donor advised funds that weren't really being planned to be given to charity anytime soon as a way of continuing to collect that fee on it. And so didn't want donor advised funds. It doesn't make a whole lot of sense, but as far as tax policy, I think it's more. I think it was more a guess as to what kind of incentives were being created by allowing the QCDs. Yes. There is not currently. And that is a point of I'm sorry. It was asked if you put money into a donor advised fund, is there a rule for when it needs to come out and go to charities? A private foundation, for example, has a requirement that it needs to distribute what amounts to about 5% of its assets every year out to charity. There isn't a rule for donor advised funds. It's been talked about for a long time. The worry is that money will just stay in these donor advised funds and not be put to work with charities. Private foundations can also contribute to donor advised funds, and I think those aren't those now subject to a rule? Maybe not. The worry there is that private foundations would satisfy their 5% rule by just parking some of it in a donor advised fund where it could sit. The thing is, when you look at the donor advised fund industry as a whole, and you look at all donor advised funds, in many years, more comes out of donor advised funds than go into donor advised funds. Almost 100% contribution rate if you kind of look at new gifts. And if you just look at all, it usually exceeds the 5% that private foundations give out, since a lot of people are using it as just a way of doing their annual giving. And so it really is going out to charity. And I think it's for that reason, and their donor advised fund industry's ability to show that to Congress is why they still haven't imposed any kind of distribution amount. That, and it would be a pain to administer if the folks here at the Catholic Foundation had to monitor a 5% distribution amount or something like that from each donor advised fund. That would be a very burdensome thing to do. So far, no. But there is many donor advised fund sponsors have a policy of, if a account has no activity for some period of time, either in or out, they will inquire with their donors about getting it active. And then if they don't for another period of time, sometimes they can then put them into their general endowment fund and put it to work. That's usually a last resort, though, and that policy differs a lot from foundation to foundation. Matthew.
Community people who do this kind of work. What do you think the effect would be? At the beginning, you showed charitable contributions maybe ticking back up. But these new law changes, what the effect might be? I was thinking in particular of the 1% limitation. Say you work for a company like UPS that has $5 billion of income now, the first $50 billion is not deductible. So wondering what the effect would be on corporate giving to their foundation.
So the question that Matthew had is what effect all of these law changes, for example, the now floor on corporate contribution amounts that can be deducted, but add to that the 0.5% for individuals and the bracket effect. And then add back in, though, the new 1,000, 2,000 non-itemizer deduction, although that's a lot of people, but a fairly small amount. I think it's unclear. I have seen some commentary that is anticipating a decline in philanthropic giving and charitable contributions, and that's troubling. Given that it took a bit to recover from the decline that we saw after the spur. But I guess we're just going to have to wait and see, which is why I always throw that slide at the beginning of the presentation, because it is interesting to see what effect all of these things do have on charitable contributions. But I think we're just going to have to wait and see. Yes.
First of all, I want to say thank you for the insights here.
You're welcome.
With I Give Catholic coming up, the Day of Giving coming up, at the end of the year, annual appeal, annual giving coming up, have you found any resources or any materials that can summarize these points so that we can get that out to donors? Like you're asking.
So I know the folks at the Catholic Foundation themselves have some resources. I would contact Juliet or someone else at the Catholic Foundation to ask, because I know they had some, because they showed them to me, of resources that they can make available. And that is one of the great things about the Catholic Foundation, is that aside from being the sponsor of endowment funds and donor advised funds in the Archdiocese, they are a planned giving and philanthropic giving resource for, or should be, and they are, for all Catholic organizations in the Archdiocese. And I'll also add, because I usually do when I speak, there are a lot of sponsors of donor-advised funds. As I mentioned, the Fidelity, the Schwabs, many accountants recommend to their clients in their tax planning at the end of the year, you need to make a charitable deduction. Here's what I would say make just to get you down below. And it's easy to then just shift that money from your investment account into the donor-advised fund sponsored by your investment firm. And I probably shouldn't be saying this as a now employee of one of these that sponsors donor-advised funds as well, but they all charge administration fees. And the Catholic Foundation is no exception. But one difference with the administration fee charged by the Catholic Foundation is if you think of it as a fee you're paying to the Catholic Foundation, you're essentially giving to another very worthy Catholic charity in the Archdiocese of Atlanta. And that, I think, is something to bear in mind because it helps making that administration fee, even if it's maybe larger than what you'd be paying at your investment provider, it makes it go down a little bit, and you can feel good about where that dollar is going, because where that dollar is going is to pay for that donor advised fund program and all of that philanthropic and planned giving advice that's being given to Catholic institutions across North Georgia. So there's my pitch for the Catholic Foundation. Yes.
Real Paul, make a QCD that is in excess of what their R&D would be still exempt at all. And the second part, so I didn't actually know the answer to that one, is you said earlier, you can do a QCD if you're over 70 and a half, even if your R&D doesn't really start because the rules change. How would you calculate how much QCD you can do between 70 and a half and like 72 or whatever?
Right. The law itself has a limit on how much you can do of qualified charitable distributions, and it is 108,000 in 2025, and that's indexed for inflation, and it's going to be 115,000 next year. There was a period where it wasn't indexed for inflation. It was just stuck at 100,000 for quite some time, but now it's become indexed from inflation again. This QCD has gone through a lot of changes. There was even a period where there was 1 year where it was only around for like the last 2 weeks of the year because of how late Congress got about addressing. It seems to be a little more permanent now, and for that reason, I think it's getting a little more attention now and is in the toolkit of a lot of the financial advisors who work with clients with large IRAs. But even if you've hit 70 and a half, you can still do up to the 115,000. But if you're not required to make RMDs yet, it's not going to count for your RMDs, but it is going to count as not being included in your income as a distribution, which you're allowed to make beginning at 59 and a half, is it, that you can do it penalty free? You can bring it into your income, but this will not be treated as having been brought into your income. So it's still a good deal, even if you don't have the benefit of it also satisfying your RMD. All right. I think I still have time. Okay. Yes. You can donate to, that you're encouraged to donate to Catholic institutions, but there is not a limit on what you can use your DAF for, as long as it is a qualified charitable organization, and in the United States primarily, because it's a lot tougher to do things overseas. But if it's your university, then yes, you can. And I think there's a minimum. What is the $250 or is it higher? Yeah. So yeah, and that's just to save, because it is an administrative. There's administrative work involved in giving that grant to the charity that you've recommended. So by having a $250 minimum on that, it saves some of the administrative burden on the foundation. Matthew.
organization that's doing work that's contrary to that is an additional.
That's right. So Matthew points out they won't give to an organization whose work is directly contrary to Catholic teaching. So that is a limitation, and that's permitted for sponsoring organizations. Any other questions? These are all been great questions. Okay.
Something to hand out tax advice to potential donors. You might want to think about whether you really want to do that, because a lot of what you're saying is actually reducing the benefits of donating. So that's something just to consider.
Yeah, might be a bad news year to talk to your donors about. In the spirit of educating your donors, it's a good idea, but in the spirit of encouraging them to give, unless you can encourage them to front load and bunch before the end of 2025, then that would be a great idea. Question? It is always a great time to do a donor advised fund. Absolutely, and there's no better place than the Catholic Foundation of North Georgia. No, that's every year. Every year. And that amount's going to start changing every year now that's adjusted for inflation. Good question. Yes. So donor advised funds are the rule for your donor advised fund, and who the advisors of it are determined by an agreement that you do when you set it up. And you are permitted to name who the advisors are. So currently, for example, my wife and I are both advisors on that donor advised fund, meaning we can make recommendations for giving. The agreement and the form of agreement that the Catholic Foundation uses allows you to appoint successor advisors if you're no longer around. So I could appoint my children to be successor advisors, and it would stay as a donor advised fund where they are advisors are. I think they can appoint successor advisors at that point, or you have a one time? Okay, one generation. Every sponsor is different about the rules they'll do. You can also elect other things. You can say that when my spouse and I are no longer here, we want it to go all out to a particular charity, just straight out. Or we want it to go to the Catholic Foundation's general endowment fund for this particular use. What I did was it converted into an endowment fund, and I have a list of about 5 charities that in varying percentages that it'll just start distributing to. The way Matthews goes half to the foundation, Catholic Foundation, half to the Catholic Center at UGA, his current endowment fund. Mine would convert into something like that for about 5 different organizations. And during our lifetime, we could amend, because we had that in there as well, our agreement with the Catholic Foundation to rejigger that list of 5 if one of them maybe falls out of favor or another one becomes more attractive to us. Yes, question.
You can transfer between one donor advised fund and another. Is that?
What do y'all have policy-wise on that?
To the Catholic Foundation donor advice to their, some people have more than one.
Yes, that depends again on the rules of the sponsoring organization. Some make it difficult for you to transfer to another donor advised fund. Some don't care. They'll treat it as a distribution to any other public charity, and if you're directing it go into a donor advised fund, that's between you and the new charity. Some, and mainly we see it in community foundations, have a rule they won't give to another charity if it's going to go into a donor advised fund. Another question? No, and in fact, we, I don't know, private foundations, which were a lot of some of our more wealthier clients used to create. I have converted more private foundations into donor advised funds than I have set up of private foundations by far in the last decade or so of my career. I mean, we just a phone call this morning just to get the client's final go ahead to terminate their private foundation. Private foundations have a lot more rules. They have a lot more tax compliance rule. There's tax returns they have to fill out every year. There are, they pay a tax. It's small, but it's an excise tax. They have that 5% mandatory distribution requirement. None of those rules apply to, and contributions to them are subject to more severe limits if you're giving large percentages of your income to a private foundation, or the asset types that you're giving, you can have more severe limitations on how much you can contribute as opposed to a donor advised fund. So clients that used to be in the tens of millions creating private foundations are now often creating donor advised funds, if their intention with their private foundation is just grant making, kind of the annual grant making that many private foundations do. Now, if you want to have employees, or you're trying for a very particular mission, or there's going to be an operating element to your foundation, then you may need a private foundation structure, because you can't do a lot of that through a donor advised fund. But if you're just a traditional family foundation that makes grants every year, a donor advised fund works even for very large sums. So no, there is no limit on what the Catholic Foundation will take from you and set up a donor advised fund. They are happy to extend it out as many zeros as you'd like. All right, with that, we'll conclude. Thank you so much for having me.
Thank you, Nick. And here's Cherish Cruz, one of our board members and a state attorney, and members of our Professional Advisors Network Steering Committee.
Hi, everyone. Thank you for coming today. I love this huge turnout. So I'm on the steering committee that has been revived. We're planning right now for a lot of events next year. So if you are an advisor is an insurance agent, I see some of my wonderful friends here, financial advisor, attorneys, we are going to be having a lot more events. If you are interested in joining or participating, please reach out to me on LinkedIn. My name is Cherish Cruz. We want to seek input. Thank you, Nick. I always love hearing you speak at bar presentations, but also at our events as well, too. So we are trying to grow this organization. And I think there are a lot of advisors within the Catholic community that I know of, but they might not know of us. So if you can please help spread the word. We are a wonderful, fun organization. Wonderful friendships have been built through all of our events, and I hope to see you at our next one. Thanks.
Thank you, Cherish. So in closing, the staff at the Catholic Foundation of North Georgia, thank you all so much for being here. We hope you got some real valuable information. I know I did, so thank you so much. So again, as Cherish mentioned, we invite you to partner with us to expand this community. There's a lot of need, right? There's a lot of need. So let's all work together to help our fellow brothers and sisters. And let's do that. But I want to thank so much, again, Nick Djuric for presenting. I want to thank our partners, Pregnancy Aid Clinic, our board of directors, volunteers, committee members that are here with us today and help us do the work that we do, help us in our mission in the Catholic community. We invite you to please come to our 6th annual investment forum at Dunwoody Country Club. Once again, this investment forum is very well received. We have one of the Federal Reserve Bank experts is going to speak at that event. More information will come out in the survey that we'll be sending out tomorrow. So please do complete that survey. We value your feedback. This is how we plan and look for topics that really are important to you all. So we appreciate that. So thank you again so much for being here. We're very grateful and have a blessed day.